Hi, my name is Paul Nichols. I'm the president of Financial Abundance, a registered investment advisory firm in the beautiful state of Pennsylvania. And we're coming to you every week, as we normally do, with a 2, 3, 4-minute coaching session we like to call a virtual coaching session, because in our firm we believe education plus understanding leads to clarity and confidence that can result in peace of mind. And you know, there's a lot of bewilderment and baffling thought processes out there right now, or baffling information. We're constantly inundated by the mainstream press and media with a lot of information. It constantly keeps us searching for the truth. And one of the things that I've noticed in the industry as a whole is there's a few myths that are propagated and constantly practiced. And it really is to the advantage of the industry more than you and I and individual investors. So we want to focus on the concept of market timing today. It's one of the myths that we dispel in one of the modules of training that we have. In fact, let's go in and get into that. We want to go through a few slides and share some data with you. First of all, market timing, what is it? It's any attempt to alter or change the mix of assets based on a prediction or forecast about the future. The myth is that money managers are able to utilize market timing to effectively and predictably predict up and down markets, So let's look at the information and see what we have. Well, first of all, let's take a report that comes out every year from Dalbar. Dalbar is a research institute up in Boston. They do a massive study every year on individual investors' behavior and the results in their returns. Now, these studies are based on 20-year time frames. They're based on at least $100,000 being invested. So we're not just talking about inexperienced investors here, okay? Now here's what basically the data proves out. If we can get pretty close to just this section here, Luke, what we notice here is if you were invested in the S&P 500 index from 87 to 08, you would have earned about 8.64%. By the way, 2008 really dragged that number down a bit as it relates to that 20-year average. But the average equity fund investor, this is the average investor out there buying and selling mutual funds in their 401ks, IRAs, or outside of those, they only earned about 1.87% according to Dalbar. The reason for this is because of track record investing, chasing the market and stock picking and the cost involved with constantly trying to time and chase the market. That's why their returns were so low. When you look at a systematic equity fund investor, which is somebody who systematically puts money in, a lot of you might think of that as dollar cost averaging, but it's really systematic investing like you might do in your 401k. They picked up a little bit better, 2.7%. So what we have is basically, when you look at inflation, a difference of negative 0.8%. When you take the amount of return they got and back out almost 3% inflation, average inflation, what we end up with is that you're really in the negative. Now, here's why. This was a study done. It took January 1, 1996 to December 31, 2006. This was Morningstar information, and they took the S&P 500 index fund. Now, we're talking about a 10-year period or 2,520 trading days. There's 252 trading days in every year. Take out holidays, weekends, etc. So what we have is if you would have been invested in that whole time frame, you would have earned about 8.33% or turned 10 grand into 22,000. But had you missed the best 10 days of that 10-year period, your returns would have dropped down to 3.32%. Now, a recent example of this was back in, I believe it was October, we had a Friday that dropped 800 points in the Dow. And then the next Monday, we had a run-up of 1,000 points. So what happened to all those people that weren't in the market? They missed about a 14% run-up in one day. But look what happens is you miss days in the market. This is trying to time the market by being in and out of it. It goes all the way down to a negative 10% if you miss just 2% of the days in the market. Folks, you can't time the market. What you need to do is you need to focus, basically, you need to focus on having a well-diversified portfolio and holding it for whatever term it needs to be held for. If you're that antsy about the market, part of that is a lack of education, which is propagated by the industry, but the other part of it is a matter of you really understanding how the market works and understanding that you need to be in the market to get market returns, but by trying to time the market, not only do you risk losing returns, but you also have the cost involved. One last thing here, Luke, I'm sorry, I'm going to go to one last slide. The evidence on investment managers' success with market timing is impressive and overwhelmingly negative. This is from Charles Ellis, who wrote a book called Investment Policy, as well as a book called Winning at the Loser's Game. This guy's a professor, has an MBA at Yale, New York University. This is what all the academics say. Basically, market timing doesn't work, stock picking doesn't work, track record investing doesn't work. We have plenty of academic studies from Yale, University of Chicago, Princeton, Harvard. Folks, get educated. The information's out there. If you'd like to learn more about an academic and educational approach to investing, we want to pull back the curtain on the financial services industry and expose the truth about money and investing. Give our office a call, 814-867-5745. Again, it's 814-867-5745, or go to our website, Financial Abundance Inc. That's INC, Financial Abundance Inc. This has been Paul Nichols with another virtual coaching session. We'll see you next week. Have a great day.